All right, in this chapter we're going to discuss risk, real options, and capital budgeting. The key concepts, we will talk about decision trees, we will talk about sensitivity and scenario analysis, Monte Carlo simulation, break-even analysis, and real options, and the chapter outline as shown. First of all, we're going to go through an example of a decision tree. Decision trees allow us to graphically represent the alternatives available to us and to map out the consequences of those decisions or those alternatives. So the objective here is to identify the best course of action. Here's a start of a decision tree. Squares in our decision tree will represent decisions and circles will represent information. So we start out with a very simple decision: should we study finance or should we not study? And those are pretty much the only two options we have. Either we do or we don't. Now for the outcome, circles represent the receipt of information. If we study, we could earn an A, B, or a C. And if we don't study, D or F. In other words, if we don't study, A, B, C are out. Now let's look at a more detailed example, Stewart Pharmaceuticals. Stewart is considering the development of a cure for the common cold. And they have put together a planning group. Representatives from a number of areas have recommended that they go ahead with a test and development phase. This preliminary test and development phase will last 1 year and it'll cost $1 billion. And the group believes that the outcome of this phase will be a 60% chance that the test will prove successful. In other words, there's a 60% chance that this product should go forward. The initial tests, if they are successful, Stewart will have to invest an additional $1.6 billion for a full production facility, and then over the ensuing 4 years the company will market this cold remedy. And so here is a picture of what things look like if the project is successful, and I'm going to build this on a spreadsheet because I want to use it later. So let me just flip back and forth. We'll start out with, get the spreadsheet. We'll start out with revenue here. I guess we can put it right there. And for now, let's just leave it the way it is. So we'll put in the 7,000. Understand that that's dollars. And then we have variable costs. Now, as the thing sits right now, if you look at this example, the variable costs are $3 billion. But in order to make those variable, we need to make them a function of revenue. So it looks like about 3/7 of every dollar of revenue is going to be variable costs. So I'm going to build a fraction in here, 3 divided by 7 times the 7 million. And actually I want to actually make that negative just to keep consistent with our other example. Next are the fixed costs, and the fixed costs will we don't have to worry about building a formula since they never change. They're by definition fixed. I believe that was 1.8 billion. 1.8. So next we have depreciation. And actually depreciation, I'm going to go up here and I'm going to put right up here initial investment or property, plant, and equipment, and it's going to be 1.6 billion. And then the depreciation is going to be whatever the cost is divided by 4. And again, I want to make that a negative just to be consistent. And so if we take the revenue, subtract variable costs, subtract fixed costs, and subtract depreciation, we will get pre-tax profit. So let's make pre-tax profit, sometimes called earnings before taxes. And we will take the, well, actually, you know, what we can do is just add those things together since I already have some positive and some negative. And there's the 1.8 billion of pre-tax profit. To that we will apply the taxes. And I believe the tax is 34%, but we'll check in a minute. Tax is 34%. So if we take this pre-tax profit times 0.34, that'll give us the tax. And again, let's just build that as a negative. And so now we have net income, and it'll be equal to the pre-tax profit minus the taxes. And then we have the operating cash flow. And the operating cash flow will be equal to the net income using the bottom-up approach that we talked about in the lesson 8. It'll be the net income plus the depreciation. And since depreciation is up here as a negative, I'll subtract it. So there's the operating cash flow. And let's continue with the example. Now, the relevant cost of capital in this example is 10%. So let's also build a opportunity cost of capital and put 10%. And now we're going to calculate the net present value. And the net present value will be equal to the cost, this 1.6 billion, plus present value of the cash flows, and the rate again is 10%. And there are 4 periods. And the payment is going to be, now I'm going to put a negative sign in here because the present value function is going to flip the sign on me. So if I put in a negative, I'll get out a positive. And that should give me the, whoops, we just certainly don't want that to be percent, so let's go back and reformat that as dollars. And so it looks like the net present value, if we're successful, is going to be 3.433.75. And there it is right there, 3.433, $3,433,750,000. All right, so that's going to be useful for later. Now, if the project is unsuccessful, and I don't need to build this one, this is not one I want to play with, but you see the revenues will be lower. The variable costs, I believe, will still be 3/7 of every dollar. The fixed cost still 1.8 billion. The depreciation stays the same. Pre-tax profit is lower. The taxes are lower. We get a cash flow of only 475 million. And if we plug that into our net present value formula, we're going to get a negative net present value. So actually, if the test is unsuccessful, this is a losing project, and we probably don't even want to do it, is what it amounts to. Now let's build our decision tree, and we start out with the question of should we test or should we not test. Now I'm assuming that if we don't test, we've basically decided to scrap the whole idea. There's no reason to go ahead. So we move to testing, and then we look at the outcome of the test. And there are 2 possibilities. Either it's successful or it's a failure. And we've already calculated what will happen. If the project is successful, we now have a decision to make. Should we go ahead or not? And if we proceed and make the investment, we will have a net present value of 3.4 billion. Remember now, given that the test was successful, there's a 60% chance that of success, and so there's a 60% chance that we'll get that 3.4 billion. We could also decide to not invest, and if we don't invest, we do nothing. Or the test could be a failure, in which case we could either invest or not invest. And again, if we don't invest, we have nothing, and if we do invest, we lose 91.46 million. Now at this point, every time there's a box, we can make a decision. And it looks like if the test is successful, the thing to do is invest. So usually you would put a couple of lines through the do not invest part of that decision. And if the test is a failure, obviously we would not go ahead and invest. So we would put a couple of lines through the invest part down there. So it looks like we have a 60% chance of success, in which case we'll have a net present value of 3.4 billion, and a 40% chance of failure, in which case we'll have 0. Now, the firm has two decisions to make. The first is, should we invest? And the second is, should we test? So we're going to kind of work backwards, starting with the decision, should we test or not? And then we'll make the decision about whether or not to, I'm sorry, we're going to start with the decision of whether to invest, and then we'll decide whether to test. So, okay, the decision, I got backwards again, okay. The decision to test. If we go back to the first stage, the decision boils down to a simple question, should we invest? And the expected payoff on investing is the following. We'll take the probability of success, which is 60%, and the payoff given success, which is that 3.433 billion, and the probability of failure, which is 40%, and the best choice there would be to do nothing. And so if you calculate that, the expected payoff is $2,060 million. Now, as far as the net present value, that's the net present value at time 2. We then bring that, or time 1, we then bring that back to time 0 by discounting by 10%, and we subtract the cost of the test. And then you see that what we have is an $872 million net present value of investing. And so the decision is, yes, let's go ahead and invest. Now, let's move on to sensitivity, scenario, and break-even, and these three things go together pretty well. Each of these is a way of looking at how firm our estimates really are. And so if we're working with a spreadsheet, we're going to try to build your model so that you can adjust the variables. And I have built that model, so maybe we'll play around with it. All right, let's start out with sensitivity. Let's ask a question. If Stewart Pharmaceuticals had a drop in revenue of, say, 14%, what would happen to net present value? Now, let me go back to my spreadsheet for a minute. And here's the base case. So I want to save this. I'm going to take this, which is right now a formula, and I'm going to copy it and I'm going to paste it as a number or a value so that it won't change. And then I'm going to go up here and I'm going to let the revenues decrease by 14%. Well, so let me do the same thing with revenue too. Copy and paste it as a value. Okay, now let's label this the base. And now let's let the revenue drop by 14%. So we'll take this $7 billion and we'll multiply by 1 minus 0.14. That'll decrease the revenue by 14%. And what you see now is that the net present value has dropped also. The net present value has gone from 3.4 billion to 2.26 billion. Now let's calculate the percentage of drop. Now we know, because this is where we build it, but we'll calculate it anyway, we know what the drop in revenue was. It was 14%, and if you like, I can format that as a percent. And we can do the same calculation down here. And you see that the net present value in this case dropped by 34%. Okay, so a 14% drop in net present in revenue causes a 34% drop in net present value. And if you want the sensitivity, you'd say, well, what is the change in net present value per percent change in revenue? And so you can calculate a ratio. You can take the change in net present value and divide by the percent change in revenue. And once again, I really don't want that to be percent at this point. I just want it to be a number. And so sometimes Excel takes a few liberties with your formatting for you. It kind of anticipates you're going to want something when you don't. So what does this say, this 2.44? It tells us how sensitive net present value is to a change in revenue. And it says that for every 1% increase in revenue, we will have a 2.44% increase in net present value, or decrease. Works both ways. So let's go back. Now, unfortunately, there's an error in the slide. The slide says that a 14% drop in revenue will lead to a 61% drop in net present value. But the same idea. We calculate the percent change in revenue, we calculate the percent change in net present value, and then we calculate a ratio, and the ratio that they came up with is 4.26. And I'm not so concerned about the numbers. We can always correct arithmetic mistakes, but what I'm concerned about is that you understand the concept of sensitivity. Just the idea that there is a positive relationship between net present value and revenue. If we increase revenue, we increase net present value. If we decrease revenue, we decrease net present value. And the bigger that number is, the more sensitive net present value is to a change in the variable. Now, what's the point of all this? What are we looking for? What we're looking for, as the name suggests, is we're looking for variables that the net present value is sensitive to. So the bigger the number, the more sensitive our net present value is to that number. And because there's more sensitivity, we want to be more concerned about how accurate we have been with that particular number. So in this case, 4.26 is a fairly large number, and we would want to be quite concerned about our estimate of revenue. Okay, let's move on to scenario analysis. Now with the first one, with sensitivity analysis, we were really looking at the change in net present value given a change in an isolated single variable. Here what we're going to do is we're going to postulate a scenario, and we're going to look at changes in a number of variables that are consistent with our scenario and see what that would do to our net present value. So a scenario. Here are some possible scenarios, and there are many others, and this is simply a matter of anticipating what could happen. One scenario is that next year we'll have a heavy cold season, that sales will exceed expectations, but also labor costs might skyrocket. So they're describing a scenario in which both revenue and costs will go up. Another scenario, next year's normal and sales meet expectations, and that's the base case that we've already built. And a third possible scenario would be that next year we'll have a lighter than normal cold season and sales will fail to meet expectations. And you can imagine all kinds of scenarios, things about the drug doesn't get FDA approval, or there's some kind of health risk associated with it that causes lawsuits. I mean, there are all kinds of possible things. So each of those scenarios will result in changes in one or more variables, and we would want to work through each of those scenarios. And what we're looking for here is scary things, scenarios that make us feel a little nervous about engaging in this particular project. Now, break-even is the third tool that I'm going to describe. This is a very common tool in analyzing the relationship between sales and profitability. And actually, there are three common break-even measures. The first is accounting break-even, and that's the one that most of you are familiar with for if you've had managerial accounting. And that's where we look at how much the sales volume can drop before we have net income of zero. Then there's cash break-even, and that asks us how much sales volume can drop before we have a cash flow of zero. And the third and the most important is financial break-even, and that's the question, how far can sales drop before our net present value goes to zero? So before we go through these calculations, here's what I want to do. Let me go back here and put back the 7 million or 7 billion, keep my figures straight, and just delete this extra information over here. And let's ask the question, and I'm going to let the spreadsheet do the work. How low would revenues be before net income became zero? Now here's what we're going to do. We're going to do a goal seek. So we're going to go to what if analysis on the spreadsheet. We're going to select goal seek, and we'll move this out of the way just to kind of hold hold the left button down as you put the arrow over the blue bar. And the cell I'm interested in is the net income cell. And I want to set that to a value of 0 by changing the revenue cell. So in other words, I'm asking the computer to find the value in C4, that's the revenue cell, that makes the net income cell equal to 0, and just click OK, and very quickly you see that it comes up with $3.8 billion, and you see that our net income would be 0. Now notice that when the net income is 0, the operating cash flow is 400. That's because the operating cash flow is just the depreciation expense. Now the next kind of break even, and this is equally as easy, is operating cash flow. So I'll go once again to GoalSeek, and I want to set this time operating cash flow to 0. So just put a 0 in by changing revenue, and click OK. And you can see that the revenue is even smaller. The revenue is now $2.78 billion, and the operating cash flow is 0. And not surprisingly, the net present value now is exactly the cost of the property, plant, and equipment, because we have a negative $1.6 billion outflow and no operating cash flow coming back. So the present value of the future cash flows is 0. The third type of break-even is to set the net present value equal to 0. So once again, we'll go to GoalSeek, and we will set the net present value cell equal to 0 by changing, we can get this thing to click on here, by changing the revenue number, and just say OK. And there you see that our revenue can drop to $4.127 billion before the net present value is 0. Now, a reasonable question to ask yourself is, well, which of these break-evens am I most concerned with? And the answer is, since we're concerned about net present value is our primary decision tool. Economic break-even is the break-even that we in finance are concerned about. We really don't care about the traditional accounting break-even, and we don't care about cash flow break-even. In fact, if you were to hit either one of those, the traditional break-even, the accounting break-even, or the cash flow break-even, you would actually have negative net present value, and you would destroy wealth. And I can think of an example where a major airplane defense contractor bid on a military project using accounting break-even, won the bid, and almost bankrupted the company by destroying so much wealth, because they actually bid a price that created a negative net present value. Anyway, now we're going to go through some slides that show you an alternative way to calculate break-even, and my suggestion to you is that you just use GoalSeek. But here's where we start. We say, well, look, we have, at least for net present value break-even, we have a cost of $1.6 billion. So what we need is 4 cash flows that have a present value of $1.6 billion at 10% interest. So we calculate a payment, and turns out that the payment that we need is $504.75 billion. So our operating cash flow needs to be $504.75 billion. Now we set up our income statement, and we put in the numbers that we have, and we sort of work backwards. Now I want to point out that they're not going to come up with the same number that I did, and the reason is they have sort of treated variable costs as if it was fixed. You notice they've built a $3 billion variable cost in here, even though they don't know what the revenue is. And that's why we're going to come up with a different value. But if we take the operating cash flow, we know it's equal to net income plus depreciation. Therefore, you can back out subtract off the depreciation, and that tells you that the net income must be 104.75. And then you can ask, well, what, if I'm taking 34% tax, 34% of what will give me, actually it would be, 66% of what would give us 104.75. So if you divide by 0.66, you find out that the earnings before interest and taxes has to be 158. And so we subtracted something, we subtracted 3 billion, 1.8 billion, and 400, and we ended up with 158. So you add everything back, and you find out that the revenue is 5.358 billion. And as I pointed out, that's too high. And the reason it's wrong, the reason this number is wrong is because the variable costs are actually 3/7 of a dollar for each dollar of revenue. So we don't have 7 billion of revenue, so we wouldn't have 3 billion of variable costs either. And that's why I think it's a lot easier for you and more accurate if you just use GoalSeek. Okay. Now, we can go a step further, and we can go from break-even revenue to break-even prices. Now, the original plan was to generate revenue of $7 billion, and we planned on selling a cold cure at $10 a dose and selling 700 million doses. So if you do a little math, once you have the revenue break-even, you can say, well, $5 billion of revenue is 700 million times what price? And the answer is $7.68 per dose. Now you can very easily do this using a GoalSeek, just as we did before. Just set up the number of doses times the price per dose and use a GoalSeek on the price per dose. But $7.68 per dose, if we go below that, we're going to have negative net present value. So what you're going to do is you're going to ask yourself, well, is this something I'm worried about? Do I think that I'm going to end up going below $7.68 per dose? If you think that's a possibility, then you're going to be a little worried about this project. Now, the other method we want to talk about is Monte Carlo simulation. And Monte Carlo simulation is an attempt to build real-world uncertainty into our model. And the way it works is, at this time, instead of having scenarios where we change individual numbers in certain ways, we're going to define probability behavior for variables, and we're going to let each variable behave randomly based on what we think the probability behavior could be. And I'm not going to go through an example of that here, but here's a simple example, something you might use Monte Carlo simulation to do. Suppose you're playing blackjack. Now, as you know, blackjack is sometimes called 21, and the idea is to get as close to 21 without going over and to be higher than your opponent, and you win. But suppose that a woman is thinking about playing blackjack, and the question is, whenever I have 16 for the first two cards, whenever my first two cards add up to 16, should I take a hit? Should I take a third card? Well, if you were a pretty sharp mathematician, you could probably work the probabilities out without doing Monte Carlo simulation. But what you could also do is write a little computer program and just randomly draw a couple of cards from a deck, and whenever you get 16, you could keep track of whether, when you drew a third card, if you went over 21. And you could count the number of times you went over 21, and you could calculate the probability of failing. So you could work this out by trial and error using millions, thousands, hundreds of thousands, millions of trials. And that's what Monte Carlo simulation is. And we can do Monte Carlo simulation of many, many things, capital budgeting projects being one of them. Usually this is considered to be a little more sophisticated than sensitivity or scenario analysis, and it is. But you have to remember this, garbage in, garbage out. While it's a more sophisticated approach, it isn't better unless the estimates the random behavior of the variables that you're using is accurate. Unless those estimates are accurate, you're not going to come out with a reliable outcome. Okay. Now, interactions between variables are explicitly specified in the simulation. So we have a model, and all we're doing is letting the variables behave randomly. Okay, this Monte Carlo simulation was first pioneered in the pharmaceutical industry, but it is used in other industries. Let's talk a little bit about real options. So an option, what is an option? An option is the possibility of doing something. And of course, you may have heard we're out of options, and what that means is, well, we basically lost the game. We're cornered and we have nowhere to go. Because corporations make decisions in a continuously changing environment, they have options, and let's consider some of those options. The first is the option to expand. We can always, if things are going well, say, let's gear up and double our capacity, or let's add some more capacity. The option to abandon. Just because there's the old saying, don't throw good money after bad, or sunk costs are irrelevant, as we talked about. So when we talk about the option to abandon, if things are going badly and the future doesn't look good, there's no reason to continue going. We can always cancel a project. And the option to delay. And this is really a timing option. We could make a decision to go forward with a project today, or if it makes sense, we could put it off until next year, or the year after that, or the year after that. Suppose, for example, that the costs of the project are coming down, and we believe they'll continue to come down. It might make sense to prolong the start of the project until next year when the costs are lower. Okay, we can calculate the market value of a project as the sum of the project without options and the present value of the options. So the market value there is equal to the net present value plus the value of the options. And a good example might be looking at a specialized machine versus a very general machine, and to ask ourselves what are the options related to both of those. Let's look at the option to abandon. Suppose that we have a plan to drill an oil well, and the rig will cost $300 if we buy it now, and in 1 year either the well will be a success or a failure. Now, of course, in real life it doesn't take a whole year to drill an oil well, and I don't think you can buy a rig for $300, but that's all that aside. We will assume that the outcomes are equally likely. In other words, 50% chance the well will be successful, 50% chance it's a failure. The appropriate discount rate is 10%, and once again, interjecting a little reality into this, it's unlikely that 10% would be an appropriate discount rate for some project that only had a 50% chance of success. The failure rate is very high, the risk is very high, and the discount rate should reflect the risk. Well, the present value of a successful payoff 1 year from now will be $575, and the present value of an unsuccessful payoff will be 0. So with traditional net present value analysis, we'll calculate the expected payoff, and it'll be 50% times the successful payoff plus 50% times 0, and so the expected payoff is $287.50. And if we take the present value of the $287.50 at 10% and subtract the initial cost of $300, we see that the net present value is $38.64. Now that is the net present value of the well without any options. But there is an option, and the option is something that wasn't stated but something we should realize, and that is if the thing is a failure, we can always sell the drilling rig. So there is some salvage value, and that's the option to abandon. So if we drill, and I believe they've changed the numbers here, but if we drill and we have success, we will have $500 payoff. But if we fail, we have an option. We can either sit on the rig, stare at an empty hole, and call it a total loss and walk away from it, or we can take our rig and sell it in the used rig market for $250. Obviously, if we fail, the prudent thing to do would be to sell the rig, to salvage it. So really, on the failure branch, instead of putting a 0, we want to put a 250. So we have this now. There's the 50% chance of success times 575, and the 50% chance of failure, in which case we salvage 250. And now the expected payoff is $412.50. And now when we calculate the net present value, we get $75. Now remember that we said that the value of the firm was equal to the net present value plus the value of the option, like that. And so we know that the value of the firm with the option is 75, and the net present value without the option is minus 38. So the option, if we do a little calculation, must be worth $113.64. And if you calculate that, that'll be the present value of 1/2 the salvage. Now here's an example of an option to delay. We have a project, and we have the option of engaging in the project now, or 1 year from now, or 2 years from now, or 3 years from now, or 4 years from now. The costs of this project are dropping. Perhaps there are technological improvements being made, discoveries. Right now it would cost us $20,000 to engage in the project, but if we wait a year, the cost will drop by $2,000, by 10%, to $1,800. In 2 years, the cost would be down to $17,100, and in 3 years, $16,929, and so on. Now, in any case, the present value of the future cash flows will remain at $25,000. So we can calculate the net present value if we did it now. It would be the present value of the cash flows minus the cost, or $5,000. We can calculate the net present value if we wait a year. It'll be $25,000 minus 18, or 7. Remember, that will be the net present value in 1 year. In 2 years, the net present value would be $7,900. So the net present value keeps going up, but we keep pushing the project further and further into the future. And so what we need to do is bring those net present values all back to time 0. And when we do that, we see that it makes sense for us to postpone the decision for 1 year. It makes sense for us to postpone the decision for 2 years. But between 2 and 3 years, the present value of the net present value actually starts dropping. So what we see here is that it makes sense for us to delay the implementation of this project for 2 years, and that's the optimal delay. And after that, it doesn't make sense to delay any further. Okay, and there's where the 6529 came from. It's the $7,900 in 2 years, discounted by 10% for 2 years. All right, that completes our discussion. Let's go through a quick quiz. What information does a decision tree provide? I hope you're saying to yourself that a decision tree gives me a visualization of the decisions and the information that I expect to receive as a result of those decisions. It enables me to map out a sort of an optimal strategy, and then to work my way back from the what I think is going to happen back to the present, and make intelligent decisions along the way. Sensitivity analysis, scenario analysis, break-even analysis, and simulation. I think you should be able to do them, and I think you should be able to explain what the difference is. Sensitivity analysis looks at how sensitive our output is to a single variable with everything else held constant. So sensitivity analysis is just isolating on one single variable. Scenario analysis allows us to focus on changes in many variables simultaneously associated with a particular feasible outcome or feasible event. Break-even analysis allows us to kind of ask some what-if questions. How low could revenue go? How low can prices go? in bidding. It's used in bidding to determine how low you could be able to set your bid and still be able to make money, that sort of thing. And Monte Carlo simulation allows us to build sophisticated or complex random probabilities into the variables and let them interact in complex ways, and then we can get a picture of the output. Why are these analyses important? Well, look, here's the deal. Up to this point, if you think about where we've been, we talked about back in Chapter 4, we built some tools, present value, future value, payments, internal rate of return we talked about a little later, net present value, tools for capital budgeting. We looked at bonds, we looked at stocks, we talked about capital budgeting, but up until now we've sort of been assuming that the cash flows, we knew what they were and we were right. We could see into the future and we knew what the future was. We knew what the appropriate interest rate was. Now we introduce reality, and the reality is that when we look into the future, everything in the future is a guess. And because it's a guess, we could be wrong, and we need to look at alternatives to examine, well, okay, just exactly how far afield of what we think will happen could we be? And that's what these tools are for. They're to allow us to deal with uncertainty and risk. And we talked about real options. And the point here is that all of these options, usually they're not explicitly stated, they're implicit, but all of these options add value to what we're doing, and we need to consider them when we're looking at a project. And that concludes our discussion.